Mercados, abrimos capítulo ya para 2023 e intentamos adelantarnos a los principales escenarios. Y lo hacemos con el foco puesto en el análisis internacional. Saludamos ya a Mark Dowding, es CEO de BLUEBAY Asset Management. Mark, thank you so much for having us a few minutes.
Thanks very much for having me on.
Mark, New Year is coming. It's been a difficult 2022 for fixed income and equity markets. What market environment do you expect for 2023?
So I think that 2023 could be a game of two halves. I think at the beginning of the year, we're still dealing with the fact that interest rates continue to move higher on both sides of the Atlantic. And I think until we have certainty over interest rates topping out, I think it's going to be difficult for markets to make much headway. That said, we do think that rates will peak come the end of March, both in the Eurozone and also in the United States. And therefore, the outlook thereafter may look more constructive. So a bit bearish at the start of the year, I'm afraid, but it will be looking better as we progress through the course of the year.
Rates, as you say, is the main tool for central banks to fight inflation, and the ECB in the last monetary policy meeting talked about the reduction of its balance sheet from March 2023 until July, and then they will study probably a new calibration of the quantity of this reduction. What can we expect from central banks, from the Federal Reserve and the ECB for this new year?
Well, at the moment, we are hearing messaging from central banks, which is still relatively hawkish. Central banks feel at the moment, although we're starting to get some better news now on inflation, it's still premature for central banks to declare victory against the battle on inflation. And therefore, we still think that central banks are going to retain this fairly hawkish stance coming into the new year. But we do think that as 2023 progresses, we're likely to see somewhat weaker growth outcomes. We're likely to see weaker inflation outcomes. And thereafter, beyond the spring, we think that central banks will be able to take a more sanguine view in terms of the outlook for monetary policy. That said, we do think it's premature to think that the central banks, after raising rates, will quickly be reducing interest rates once again. We think that interest rates are likely to stay at elevated levels for some time. And so we do think perhaps in the course of the last 1 or 2 months, particularly in the US, it's been a bit premature for investors to want to buy duration, thinking that it's time for yields to rally. I think we need to be patient. We need to see central banks reach a top in rates before that rally can really take place.
And when central banks will talk about peak on inflation, what can we expect from inflation in the short, medium term?
Yeah, so central banks are still expecting inflation to remain above their targets this time next year. So there is a sense in which inflation is going to be coming down on both sides of the Atlantic, but it's still going to remain uncomfortably high for a period longer. And against that backdrop, we do feel that central banks are going to retain a fairly hawkish stance for the time being. And so this is relatively problematic for investors. I would suggest that when markets turn, you should see government bond markets turn first. The second markets to turn should be high quality credit markets. And it'll probably be the equity markets which are the last markets to turn, because remember that equity markets are going to be dealing with an outlook where growth is weaker and there's some pressure on corporate earnings during the course of 2023.
What about the recession? Which do you think will be the magnitude of a recession in Europe and in the US?
Yeah, so in terms of the growth outlook, I think that with monetary policy tightening, we may well see a very mild recession in the US. But we're only talking about a recession under which we see the unemployment rate, for example, going up to 4.5% or maybe 5%. It's not going to be a very deep or material recession in the United States. There is a risk of a more unpleasant recession in the Eurozone. Clearly, that's linked to the dynamic around energy prices as well. That said, we think that the overall outlook for the year in the Eurozone is probably a growth outcome of around about -1%. So it's not going to be a great year for growth. I would express, though, that it's actually the UK economy which looks like likely to be the economy where growth will be doing worst. Here in the UK, we are facing a much more difficult macro backdrop.
Mark, what are for you the main challenges investors must face when selecting opportunities this new year?
Well, I think that we're still in a very uncertain macro backdrop, right? If you think about all of the surprises we've had in 2022, it's one surprise after another. Even this week, we had the Bank of Japan moving its yield curve cap under yield curve control. It feels as if there is a lot of uncertainty. So I think the first thing that I'd emphasize is we're all wrestling with a degree of uncertainty. And against that backdrop, markets can remain relatively volatile. So uncertainty, volatility, this is something that we're all sort of wrestling with. But otherwise, I think the thing that we need to be cognizant about as investors is we're at a moment, at a point in time where monetary policy is moving restrictive. At the same time, growth is slowing. And this sort of backdrop is certainly an unfriendly backdrop for financial markets. It's a backdrop where we see corporate earnings struggling. It's a backdrop where we'll see credit losses accumulating. And so obviously picking the right assets and the right sectors is enormously important. All of that said, with markets having struggled really badly in 2022, we can also see pockets of value. So on a valuation basis, there are assets that certainly look cheap, but I do think you're going to have to pick your spots quite carefully.
And what assets do you see as an opportunity of investment in 2023?
Yeah, so in terms of things that I like, for example, I quite like subordinated bank debt. I look at subordinated bank debt paying 8% from high quality banks with enormous capital buffers, and I have very little worry about facing credit impairment from the leading sort of European banks. Actually, if there is a recession, I think the recession is going to cause more credit losses in areas like private markets than it will on bank balance sheets. Banks are actually run very conservatively. So subordinated bank debt we like. We also can point to the fact that banks tend to do better as interest rates go up. So that's an area within fixed income we're quite favourable towards. Otherwise, there are individual assets, individual countries and currencies in emerging markets, which look like they can be in good shape. Countries where inflation is coming down, like Brazil, like South Africa, like Mexico, are countries where we could see bond yields rally during the course of 2023. So there are going to be assets to like, but also in emerging markets, there's a lot of assets you really need to avoid, where restructuring is looking really quite imminent. So picking your spots with a degree of caution, I think is really the message of the day.
So much for this analysis, Mark Dowding, CEO of BLUEBAY Asset Management. It's been a pleasure.
Muchas gracias.
Bueno, nosotros nos quedamos por tanto con este análisis bastante interesante. Nos hablaba de